Hi, everyone. This is our CAPSIM final presentation for Team Erie. I'm getting started with our vision and mission. We envision being the leader in the sensor industry with the highest quality and the best prices. Our mission statement is to provide the most ideal products and competitive prices because customer satisfaction is our priority.
Our business goals and strategy review, we want to be the cost leader with product lifestyle focus. We intend to compete with all 5 products by following the traditional customer buying criteria as it changes over time. We'll do so by gaining an intimate understanding of what consumer wants in each product segment. Using this information, we'll follow the ideal age, price, and reliability while maintaining the ideal precision for the product. This will require close monitoring of changes in the marketplace and responding to them by making gradual adjustment over time. And for our goal, for follow customer buying criteria trend, different segments look at different quality, they value it differently. So for traditional and low-end products, we will focus more on the price, and other products will focus more on the quality. Research and development strategy. High-end product line should include sensor with great performance, small size, and highest NTBF. Performance product line should include sensor with the best performance, small sizes, and high NTBF. Size product line should include sensors with good performance, smaller size, and good NTBF. The other two need minimum research and development as long as they match customer expectation. And moving on to the marketing goal. For a more price-sensitive segment like traditional and low-end, we have to be very careful with the prices, and we also need to spend more on sales and promo to capture more potential customer. And we do not need to spend as much sales and promo on the other 3 segments because quality is what's more important in those segments. And our manufacturing plan increase capacity for traditional and low end and lower capacity of high end performance and size as we see fit. Inventory, we want to go above and beyond our forecast sales and while not having too many unsold products left. We want to keep track of sales and trend of the growth to make more accurate estimation about our future sales, and increase automation to reduce labor costs, especially the second shift workers. And for investment, make investment to increase capacity on some product line that we sell extraordinarily well to make sure we can serve more customers, and make investment on plant and equipment to further increase our capacity on product we have no inventory left. And our production goal was adjust based on our sales last year. We add automations and we reduce productions on product that we do not sell that well last year. For our financial goal, we have simple financial goals. At the beginning, we max our stock and debt to support our research and development costs, and we want to assure our long-term debt. We want to remain low and have an ending cash balance between 30 to 40K. For our marketing plan, our high-end product did not go through revision on some of the year, and we could not compete with other companies, but we did not realize that soon enough, and we did not spend enough on sales and promotion. So despite having similar performance and size, sometimes we fail to compete with others. For our financial plan, we want to decrease our account payable below 5%, and we want to increase our earning while decreasing our debt. And we try to increase our stock price to about 40%. This is the review for our sales plan. We expected to continuously increasing, but toward the end of the year, most of the market share were actually decreasing.
Looking back, our performance each round, for round 1, our expectations was the market share to be 20% or more, and we'll have just short of $100,000 profit due to a lot of investment into the production and research and development. And we wanted to increase our production ready for future sales, meet the demand, and we wanted to have an advanced product, heavily researched and developed product line. So our plans was to increase promo and sales budget to make the sales greater, and also heavy investment, like I said, into the production and marketing, and expanding the production by increase employees and increase plants. Also heavy research and development on high-end performance and size product lines. Results was not as actually that great because other people were also researching and developing as much as we we do. So it was very competitive. We weren't actually getting as much market share, and our net profit was actually negative. But we did have increased production, but it was kind of for nothing. And we were placed at fourth and fifth in the market. So like I said, it was very competitive, and it was kind of, so the increased production was good for future rounds. We spent a lot of money, but did not gain a lot. So we decided to change our strategy a little bit, and we'll discuss for the next round.
In the second round, we anticipated a steady increase in market share, as well as greater sales in the traditional and low-end segments because we had been market leaders. We expected to earn a profit this round. Anything's better than nothing. And we also thought the competitors would make a move in the performance and size markets because those were pretty undeveloped. We planned to maintain competitive research and development in all 5 market segments, as well as focus on producing more inventory for the low and high ends because we kind of underproduced. We wanted to make more than we spent on decisions because we were in a deficit last round. And we wanted to spend more money on promotion and sales for the performance and size categories as we were a little lacking. This resulted in a stock value increase that was actually competitive with the robot and higher. If you look at the book per value per share, we were leading in sales with $166 million. We were also leading in market shares overall with a commanding lead in traditional loan size markets. And our size segment did better than we expected, and we sold all of our units, losing a little bit of revenue. To respond to this, we adjusted our production accordingly. We also need to recalibrate our inventory a little bit. The other companies spent a lot of money and had to take out some emergency loans, while we managed to fit consumer expectations perfectly without getting over our skis. In the third round, we expected the other teams to make some big changes because they were all down. We also expected more competition in the high-end market, and we thought that they were going to reveal their strategy because we were halfway through and we could kind of read them. We anticipate our market shares to be stable. So the plan was to hold those market shares, rein in our production a little bit to limit overstock, retire some debt, issue dividends, and experiment a little bit with automation to clean up our production. The results were a steady increase in our assets. We actually underestimated demand this round and ran out of stock in a couple things. We suffered a decline in our market share for high-end performance and size. We found that automation was successful. Despite some of these shortcomings, we thought that our strategy was going to dominate and we were going to continue to be successful. We resolved to clean up our inventory a little bit more with accurate predictions, adjust our production now that we knew that automation worked well. We also managed to once again fit consumer expectations pretty well.
For round 4, for our expectations, we really wanted to capitalize since we are over the halfway mark, so we were able to sort of more recognize where our competitors were at the time. So with the over demand that we had in round 3, we really wanted to focus on fixing the production issues we had in round 3 this round, as well as stay consistent to make sure we can close out with the success we had in the prior round. Next, for the plans, to assure that everything came to fruition, we want to spend more on production as well as promotion so we can broaden our consumer base. We would do this while continuing to monitor our competitors and observe our long-term debt that we pulled at the very beginning of the simulation. Lastly, for the results, our sales grew monumentally this round. Along with that, our stock price and our market cap also increased. Our return in sales took a small decline, but we were pretty happy with where we're at, given this was over the halfway mark and our sales grew so exponentially.
For round 5, we're expecting the market for traditional and low-end products will be decreasing continuously. But on the other hand, high-end performance and size will be bigger, and our price customers wanted to pay will continuously decrease, and less units will be sold as our late revision dates. So our plan was to not spend as much money on traditional and low end and more money on high end and performance and size. We wanted to increase automation so that we can save money on the cost of goods sold. We wanted to start a new product line, L, because we knew that the revision date was delaying other high-end performance size products. So we wanted to have another product that can take over the gap. However, the results wasn't as great as the traditional and low-end product sales was last sales, but it was still increasing compared to the previous years. And the other 3 high-end performance size products revision dates remained the problem. We could not make the sales, and we could not not save as much money and increase profit margins. And our new product line was not ready to be launched and be sold. We could still sell the traditional and low end well because we were staying competitive when it comes to price and quality. When we try to develop more into high end performance and size, it was kind of late. When we try to rapidly spend more money on the research and development, the revision date was keep getting delayed much later. And the automation did help, but it was not significant help to saving the costs. And the new product line was still not ready to be launched, so it was very late at this point. So for the round 6, we expected to increase some revenue as we were trying to, as we are going to start selling the new product line, and we expected to decrease much more debt by paying off early, and with the net profit will be decreased because we wanted to pay out some dividends to shareholders, and we will probably just behind first place Chester. Our plans was to make sales for traditional and low-end products and still try to sell as much we can for high-end performance and size, and we wanted to clean up our financials by paying off a lot of debt for long-term debt and just do what we can do with the new product line. The results was not as great because the traditional and low-end markets were declining continuously. So our revenue, the sales revenue, profit was all decreasing. So did the market share, and it was kind of really late at this point to make any investment. It's the last round, but at least we had the best bond grade as we remained a very stable company with continuous growth, and we had the most equity compared to other companies. And the new product line did make sales, but it was already saturated market with other companies' product lines. So we should have act more proactive when it comes to new product line and heavy investment. So staying conservative is not always a good thing when it comes to entrepreneurship. I think the company continues to grow and make more money.
Looking at our financial statements, our income statement was pretty strong. As you can see, it demonstrated that we did continue to have steady gains throughout the simulation. Our net profit margin was steadily increasing except for round 4, where there was a brief dip. On our balance sheet, our equity was strong and a very steady increase rounds 1 through 6. Our cash was also pretty steady increasing throughout the simulation, except there was a dip in the 5th and 6th rounds when we started investing more into automation and a lot of inventory. Looking at our results versus our goals, we tried to increase our capacity to meet the demands, and we also increased our level of automation, but these were a little bit too little too late. However, our goals were steady increases over time, as well as maintaining market share, and we really only got one of those because we failed to do the first part in our actual results.
Next, if we want to look at our company versus the rest of the industry that we're competing against, if we look at this chart right here, first the final round market share, every company except for Andrews did fairly similar in around the same percentile. But looking at the final score relativity summary, we did this through combining the cumulative profit, the market cap, the ROE, the ROS, the ROA, and the asset turnover. And obviously with that being a very significant score that we would look at when evaluating what we did throughout the quarter, we came in second, just behind Chester, narrowly behind Chester. As you can see also with the cumulative profit, we came in second, and the contribution margin summary, we didn't do as well as we wanted to, but we felt that when reflecting on everything, the final score summary along with the cumulative profit, we shined where we needed to the most. Next, just wrapping everything up, observing our team interaction. The reason we were able to do well, especially in a category like the relativity summary, we held meetings once a week for 1 to 2 hours in the Veterans Resources Center, and we also made a group chat, the 4 of us, at the very beginning of the quarter so we can communicate different ideas and meeting dates, and we also collaborated on various projects, as you can see here, like the 5-year plan, the mission statement, and this presentation, and we assigned each other roles that we were all responsible for very early.
Some key takeaways from the simulation were that game theory is important. Some people made unforeseen decisions that affected our success. Our intended strategy to remain consistent throughout the simulation led to steady growth, but this rigidity was also predictable. Competitors disrupted the high-end performance and size markets in the later rounds using new product lines, and we couldn't keep up. Moving forward, we learned that it's important to understand that people are going to react to our strategy in ways that will take away our competitive advantage, and we need to use emergent strategies to roll with these punches. That way you can maintain goals while still responding to competitors' action. Another important important lesson we learned is understanding the competitive environment. We failed to acknowledge that the low and traditional product segments, which we relied on as big sources of income, were shrinking faster than we anticipated. We were slow to develop our other products in a way that would make up for that and lost our competitive advantage as a result. This taught us that it's important to take a good look at how markets work in an industry and use this information to guide our strategy. Our final lesson was knowing your limits, because we failed to make an objective appraisal of our resources within the firm. Heavily investing in research and development was delaying the release of our high-end product. This took it out of the market for the last 3 rounds, and we did not take action on this before that damage was done. Because of this, we lost some opportunities to compete in that market segment. In real life, understanding the limitations of your firm is important so that you don't stretch yourself too thin. And that's all we have. Thank you.